U.S. Jobs Report July 2023. Slowdown hits labor market. Interest rate cut looms. The U.S. labor market is showing signs of strain, as evidenced by the addition of only 73,000 jobs in July, a figure that falls short of expectations and raises alarms about the overall health of employment in the country. This disappointing growth comes at a time when President Donald Trump is intensifying tariffs, which could further complicate the economic landscape. According to the Bureau of Labor Statistics, the job growth for July, while an improvement over June's meager addition of just 14,000 jobs, still lagged behind the Dow Jones forecast of 100,000 new positions. Moreover, the revisions for previous months were stark, with a total downward adjustment of 258,000 jobs for May and June combined, indicating a more troubling trend than initially thought. In addition to the sluggish job growth, the unemployment rate crept up to 4.2%, aligning with predictions but still raising concerns. The June job total was revised down from an earlier estimate of 147,000, while May's figures were slashed to a mere 19,000, a reduction of 125,000 jobs. Following the release of this report, stock market futures took a hit and Treasury yields dropped significantly, reflecting investor anxiety about the labor market's trajectory. Heather Long, the chief economist at Navy Federal Credit Union, described the report as a game changer, emphasizing the rapid deterioration of the labor market. This week's report, particularly the significant revisions, may prompt the Federal Reserve to consider lowering interest rates in its upcoming September meeting. In fact, futures traders have increased the likelihood of a rate cut to 75.5%, a notable rise from just 40% the day before, according to data from CME Group. Luke Tilley, chief economist at Wilmington Trust, remarked, "This is the slowdown that we've been expecting," pointing out that companies are grappling with a new cost structure that necessitates a more cautious approach to hiring. In July, the job gains were predominantly concentrated in the healthcare sector, which added 55,000 jobs, showcasing its resilience in the post-COVID recovery phase. Social assistance also contributed positively, with an addition of 18,000 jobs. Together, these two sectors accounted for an impressive 94% of the total job growth for the month. Retail saw a modest increase of nearly 16,000 jobs, while the financial sector added 15,000 positions. Conversely, federal government employment continued its downward trend, shedding 12,000 jobs in July, and a total of 84,000 since reaching its peak in January. This decline coincides with the efforts of Elon Musk's Department of Government Efficiency to streamline operations. Additionally, the professional and business services sector experienced a loss of 14,000 jobs. Atlanta Fed President Raphael Bostic shared his insights on CNBC, stating, "In many ways, this is about slowing down. The real challenge now is to determine how long this slowdown will last and whether it will lead to more significant issues." Although Bostic does not have a vote on the Federal Open Market Committee this year, he is actively involved in discussions and has previously indicated support for a single rate cut this year. On the wage front, average hourly earnings rose by 0.3%, meeting expectations, while the annual increase of 3.9% was slightly above forecasts. However, the household survey, which is crucial for calculating the unemployment rate, painted an even bleaker picture than the establishment survey. It revealed a decline of 260,000 workers, with the participation rate dipping to 62.2%, the lowest level since November 2022. A broader measure of unemployment, which includes discouraged workers and those working part-time for economic reasons, climbed to 7.9%, marking its highest point since March. Additionally, long-term unemployment is becoming a growing concern, with the average duration of unemployment rising to 24.1 weeks, the highest since April 2022. The number of individuals unemployed for more than 27 weeks reached 1.82 million. The highest since December 2021, representing about a quarter of all unemployed individuals. Gare Doyle, North America Regional President at Manpower Group, noted, "Today's report underscores a slow but steady cooling trend. While the labor market isn't in crisis, the momentum for hiring is diminishing, and pressures are beginning to mount." This report arrives amid increasing uncertainty regarding companies' willingness to hire, particularly in light of ongoing trade negotiations and rising tariffs. President Trump has been vocal in urging the Federal Reserve to implement aggressive interest rate cuts. However, the central bank opted to maintain its current borrowing rate during its recent meeting, despite Trump's vocal criticism. White House officials have pointed to the shifts in the job market as being influenced by the uncertainty surrounding tariff negotiations and the administration's efforts to curb illegal border crossings. Stephen Miran, chair of the Council of Economic Advisers, expressed concern over certain aspects of the report, stating, "There are elements here that we didn't want to see, and I don't think anyone wanted to see for the U.S. economy. However, we do have robust policies in place, including trade agreements and tax reforms, that should help stimulate growth moving forward." In a recent post on Truth Social, Trump expressed his frustration, calling for the Federal Open Market Committee to take decisive action against Chair Jerome Powell, whom he labeled as a stubborn moron, who must lower interest rates immediately. Following the jobs report, Trump reiterated his criticism, branding Powell as a disaster. Despite the concerns surrounding the labor market, key economic indicators remain relatively stable. The gross domestic product, GDP, grew at an annualized rate of 3% in the second quarter, significantly surpassing expectations. However, this growth was largely attributed to the unwinding of a substantial import buildup that occurred prior to Trump's Liberation Day tariff announcement on April 2nd. While consumer spending did see an uptick from the first quarter, it remains lackluster, indicating that underlying demand may still be weak. AI's impact on unemployment. The shocking jobs report explained. The latest jobs report sent a jarring alarm to financial markets on Friday, not only signaling potential economic downturns, but also hinting that artificial intelligence might be contributing to higher unemployment rates, according to J.P. Morgan. Last month, payroll numbers showed a modest increase of just 73,000 jobs, far short of the anticipated figure of around 100,000. This was compounded by downward revisions for May and June, where initial tallies of 144,000 and 147,000 were revised to a mere 19,000 and 14,000, respectively. As a result, the average monthly job gain over the last 3 months stands at a paltry 35,000. While these figures don't indicate mass layoffs, other indicators, such as weekly jobless claims and monthly job turnover surveys, suggest stability. Moreover, wages and work hours are still on the rise. However, J.P. Morgan economists noted that the primary concern lies in the significant slowdown of hiring activity, which they describe as a stall speed alert. Private sector hiring has decelerated to an average of just 52,000 jobs per month over the past 3 months, with non-healthcare and non-education sectors showing little to no growth, without any signs of increased involuntary separations due to immigration policies. This trend strongly suggests a decline in business demand for labor, a clear warning sign of an impending recession. We have repeatedly stressed that a substantial drop in labor demand is a red flag for a recession, J.P. Morgan emphasizes. Typically, businesses continue to hire even during perceived temporary economic shifts. When labor demand falls alongside economic shifts, it often precedes cost-cutting measures. Despite these signals, the broader economic picture remains one of expansion, albeit at a reduced pace. Second quarter GDP growth exceeded expectations at 3%, although a measure that excludes foreign trade indicates a slowdown. The Atlanta Fed's GDP tracker predicts a further deceleration to 2.1% in the third quarter. J.P. Morgan warns that this sluggish job growth is unlikely to support continued income gains or consumer confidence, which have shown some improvement in recent months. Meanwhile, the broader U6 unemployment rate, which includes those who are marginally attached to the workforce and those working part-time involuntarily, has risen by 0.4 percentage points this year. In contrast, the official unemployment rate has remained relatively stable, fluctuating between 4% and 4.2% over the past year. Prior to Friday's report, this stability had given the impression that the job market was resilient despite the significant tariff hikes imposed by President Donald Trump. We believe job creation can no longer be characterized as robust, J.P. Morgan stated. Combined with the growing headwinds from the trade war, this week's data strengthens our view that the Federal Reserve is approaching a period of easing. Another J.P. Morgan analysis delved into specific details within the jobs report that suggest AI's influence on the labor market. For instance, payrolls in professional and business services declined by 14,000 last month, continuing a downward trend. Additionally, the unemployment rate for college-educated workers rose from 2.5% to 2.7%, while the overall unemployment rate increased to 4.2%. J.P. Morgan notes that new entrants seem to have disproportionately contributed to the recent rise in unemployment. This aligns with earlier concerns that AI is reducing the need for entry-level positions, which are crucial for recent graduates starting their careers. However, economist Brad DeLong recently argued in an essay that the current challenges faced by young job seekers are primarily due to policy uncertainty and a sluggish economy, rather than the rapid advancement of AI technologies. DeLong contends that companies are delaying major decisions, including hiring, due to an unpredictable policy landscape exacerbated by Trump's inconsistent trade war strategies. This hesitation is particularly detrimental to newcomers, who rely on a consistent influx of entry-level opportunities to establish themselves in the workforce. This risk aversion is especially harmful for those at the beginning of their careers, who depend on a steady supply of entry-level roles to secure their first foothold in the job market, DeLong writes.